Hey guys, welcome back to another episode of Binary Campus. In this video, we will be going through our very simple yet profitable chart patterns trading strategies. If you want more videos more often, please smash the like button, subscribe and turn on the notifications bell so that you know exactly when new content is released. The very important everything we discuss in this video. You can use these strategies can be used for currency trading, stock trading, and crypto because price action stays relatively consistent across different assets. So we are going to go very in depth in this video. Chart patterns are an integral aspect of technical analysis, but they require some getting used to before they can be used effectively to help you get to grips with them. Here are 10 chart patterns every trader should. A chart pattern is a shape within a price chart that helps to suggest what prices might do next based on what they have done in the past. Chart patterns are the basis of technical analysis and require a trader to know exactly what they are looking at, as well as what they are looking for. Types of chart patterns. Chart patterns fall broadly into 3 categories: continuation patterns, reversal patterns, and bilateral pattern. That continuation chart pattern signals that an ongoing trend will continue. Continuation patterns, when they occur, it can indicate that the trend is likely to resume after the pattern completes. A pattern is considered complete when the pattern has formed or can be drawn and then breaks out of that pattern potentially, continuing on with the former trend. The reversal is anytime the trend direction of a stock or other type of asset change. A reversal pattern is the sort of pattern that indicates a change in direction from rising market to falling market and vice versa. We can use this pattern to predict the upcoming movement and open or close our trades accordingly. Bilateral chart patterns are a bit more tricky because these signal that the price can move either way. To play these chart patterns, you should consider both scenarios: upside or downside breakout, and place one order on top of the formation and another at the bottom of the form. So be careful and don't forget to place your stops too. For all of these patterns, you can take a position with contract for difference or CFDs. This is because CFDs enable you to go short as well as long, meaning you can speculate on markets falling as well as rising. You may wish to go short during a bearish reversal or continuation, or long during a bullish reversal or continuation. Whether you do so depends on the pattern and the market analysis that you have carried. The most important thing to remember when using chart patterns as part of your technical analysis is that they are not a guarantee that a market will move in that predicted direction. They are merely an indication of what might happen to an asset's price. So here are 10 chart patterns every trader should learn. First, double top. The double top is a reversal pattern that is formed after there is an extended move. The tops are peaks that are formed when the price hits a certain level that can't be broken. After hitting this level, the price will bounce off it slightly, but then return back to test the level again. If the price bounces off of that level again, then you have a double top. In this chart, you can see that 2 peaks or tops were formed after a strong move up. Notice how the second top was not able to break the high of the first. This is a strong sign that a reversal is going to occur because it is telling us that the buying pressure is just about finished with the double top. We would place our entry order below the neckline because we are anticipating a reversal of the UPT trend. The stop loss is placed above the second peak. Remember that double tops are a trend reversal formation, so you'll want to look for these after there is a strong uptrend. You'll also notice that the drop is approximately the same height as the double top form. Keep that in mind because that'll be useful in setting minimum profit targets. Second one is double bottom. The double bottom is also a trend reversal formation, but this time we are looking to go long instead of short. These formations occur after extended downtrends when 2 valleys or bottoms have been formed. You can see from this chart that after the previous downtrend, the price formed 2 valleys because it wasn't able to go below a certain level. Notice how the second bottom wasn't able to significantly break the first bottom. This is a sign that the selling pressure is about finished and that a reversal is about to occur. Look at this. The price broke the neckline and made a nice move up with the double bottom. We would place our entry order above the neckline because we are anticipating a reversal of the down. The stop loss is placed below the second valley. Third one is head and shoulders. The head and shoulders chart pattern is a popular and easy to spot pattern in technical analysis that shows a baseline with 3 peaks, the middle peak being the highest. Technical analysis. A head and shoulders pattern describes a specific chart formation that predicts a bullish to bearish trend reversal. While an inverse head and shoulders indicates the reverse, the pattern appears on all time frames and can therefore be used by all types of traders and investors. It's important that traders wait for the pattern to complete. This is so because a pattern may not develop at all, or a partially developed pattern may not complete in the future. In the head and shoulders pattern, we are waiting for price action to move lower than the neckline after the peak of the right shoulder. For the inverse head and shoulders, we wait for price movement above the neckline. After the right shoulder is formed, the most common entry point is a breakout of the neckline with a stop above or below the right shoulder. The minimum profit target is the difference of the high and low with the pattern added or subtracted from the breakout. Fourth one is triple top. The triple top is a type of chart pattern used in technical analysis to predict the reversal in the movement of an asset's price consisting of 3 peaks. A triple top signals that the asset may no longer be rallying and that lower prices may be on the way. Triple tops may occur on all time frames, but in order for the pattern to be considered a triple top, it must occur after an up. The 3 consecutive peaks make the triple top visually similar to the head and shoulders pattern. However, in this case, the middle peak is nearly equal to the other peaks. Rather than being higher, traders should only enter the short position when the price breaks out from the support level or the neckline. The stop loss should be placed at the third top of the pattern. The minimum target should be equal to the distance between your entries and the tops. Fifth one is triple bottom. The triple bottom is a bullish chart pattern used in technical analysis that's characterized by 3 equal lows followed by a breakout above the resistance level. A triple bottom is generally seen as 3 roughly equal lows, bouncing off support, followed by the price action breaching resistance. The formation of triple bottom is seen as an opportunity to enter a bullish position. Triple bottom may occur on all time frames, but in order for the pattern to be considered a triple bottom, it must occur after a downtrend. Traders should only enter the long position when the price breaks out from the resistance level or the neckline. The stop loss should be placed at the third bottom of the pattern. The minimum target should be equal to the distance between your entries and the bottom. Sixth one is cup and handle. Unlike other chart patterns, the cup and handle pattern does not work equally for both the bullish and bearish scenario, as it is almost exclusively found in the bullish scenario only. Hence, we don't hear people talking about bullish cup and handle or bearish cup and handle, because when they say cup and handle, it is understood to refer to the bullish version based on the 2 main categories of chart patterns, continuation versus reversal. Most people tend to classify the cup and handle pattern under the reversal patterns category. However, I feel that the cup and handle can be both a reversal or continuation pattern. Entering a cup and handle trade, wait for a handle to form. The handle often takes the form of a sideways or descending channel or a triangle by when the price breaks above the top of the channel or triangle. When the price moves out of the handle, the pattern is considered complete and the price is expected to rise. Place a stop loss below the lowest point of the handle. To measure the target price, take the maximum height of the cup and project that distance from the breakout point. Seventh one is wedges. Wedge pattern is a type of chart pattern that is formed by converging 2 trend lines. There are 2 types of wedge: rising and falling. Both rising and falling wedges are reversal patterns, with rising wedges representing a bearish market and falling wedges being more typical of a bullish market. Rising wedges. A rising wedge is represented by a trend line caught between 2 upwardly slanted lines of support and resistance. In this case, the line of support is steeper than the resistance line. This pattern generally signals that an asset's price will eventually decline more permanently, which is demonstrated when the prices break from the support line. Then the continuation of the downtrend is confirmed. Traders should only enter the short position. Stop loss can be placed at the upper side of the rising wedge line. The minimum price target is equal to the height of the back of the wedge. Falling wedges. A falling wedge occurs between 2 downwardly sloping levels. In this case, the line of resistance is steeper than the support. A falling wedge is usually indicative that an asset's price will rise and break through the level of resistance. The traders should take a long position when the prices break above the upper converging trend line. Stop loss can be placed at the bottom side of the falling wedge line. The minimum price target is equal to the height of the back of the wedge. Eighth one is ascending triangle. The ascending triangle is a bullish continuation pattern, which signifies the continuation of an up. Ascending triangles can be drawn onto charts by placing a horizontal line along the swing highs or the resistance, and then drawing an ascending trend line along the swing lows or the support. Ascending triangles often have 2 or more identical peak highs, which allow for the horizontal line to be drawn. The trend line signifies the overall UPT trend of the pattern, while the horizontal line indicates the historic level of resistance for that particular. As you can see, the ascending triangle has a series of higher lows approaching resistance. This is a sign of strength for 3 possible reasons. First, the buyers are willing to buy at higher prices. Second, there is lack of selling pressure. Third, buy stop orders are clustered above resistance. So where should you put your stop loss? A stop loss could be placed just below the lower trend line. Your profit target goes the same distance away as the back of the triangle. Ninth is ascending triangle. In contrast, a descending triangle signifies a bearish continuation of a downtrend. Descending triangles generally shift lower and break through the support because they are indicative of a market dominated by sellers, meaning that successively lower peaks are likely to be prevalent and unlikely to reverse. Descending triangles can be identified from a horizontal line of support and a downward sloping line of resistance. Eventually, the trend will break through the support and the downtrend will continue. As you can see, the ascending triangle has a series of lower highs approaching support. This is a sign of strength for three possible reasons. First, the sellers are willing to sell at lower prices. Second, there is lack of buying pressure. Third, sell stop orders are clustered below support. So where should you put your stop loss? A stop loss could be placed just above the upper trend line. Your minimum profit target goes the same distance away as the back of the triangle. 10th is pennant. Pennants can be either bullish or bearish, and they can represent a continuation or a reversal. When trading, the same approach can be applied to both the bullish and bearish pennant patterns. However, the bullish pennant will have a long bias in the bearish pennant. A short bias traders should look to enter the trade on confirmation of the breakout after a sudden sharp move in price. The pennant after a sharp move in price indicates that there is likely to be a breakout and continuation in the direction of the initial move. The candlestick closed below. The pennant provides short entry point. In this example, the break was rather significant and added to the likelihood of a continued move to the downside. The stop loss can be placed above the breakout candle, seeing that it was quite a big move. Or for more conservative traders, a stop can be placed above the pendant to limit upside. This usually offers an acceptable level of protection for traders. To set your minimum target levels, you can measure the distance from the beginning of the flagpole up to the pennant, then duplicate this distance from the price breakout following the pennant. All of the patterns explained in this video are useful technical indicators, which can help you to understand how or why an asset's price moved in a certain way, and which way it might move in the future. As always, if you learned something new or if you want more videos more often, make sure you subscribe. Click the notification bell and leave us a like to show your support. See you next time.